Welcome back to the deep dive. It is Thursday, February 26th, 2026. And I have to be honest with you. Usually when I sit down to prep for this,
You look for a theme.
right, exactly. I look at the week's news and I try to find that cohesive narrative.
Right.
Like, oh, inflation is up or tech is booming. It generally flows in one direction.
Yeah, but this week is a little different.
A little different is an understatement. I feel like I'm reading news from two completely different dimensions that just happen to crash into each other. Because on one hand, we have numbers that are so big they look like typos.
Mm-hmm.
And then we have numbers on the other side that are so catastrophic they also look like typos, just in the totally opposite direction.
It really is a week of whiplash for anyone paying attention. We're essentially looking at a massive split-screen economy right now.
Right.
On one side, you have this digital economy, AI, chips, the cloud, and it's generating wealth at a speed we have literally never seen before.
Never.
But then on the physical side, the economy of making cars, shipping goods, building actual things, it is hitting a brick wall at full speed.
And that total disconnect is exactly what we need to figure out for you today. Because, sure, we're going to talk about NVIDIA. We have to.
You can't ignore the gorilla in the room.
Exactly. But we're also going to look at a legacy automaker losing over 20 billion euros. We're going to look at Netflix executives visiting the White House amid a massive bidding war.
Yeah, the streaming wars are back.
Big time. But the thing that really stuck with me from the research notes this week, the thing we're building toward, is this controversial new economic concept called ghost GDP.
Ghost GDP. It sounds like a conspiracy theory.
It sounds spooky, but when I read the actual definition and the theory behind it, it honestly scared me more than a ghost story ever could.
Because it suggests a future where the line on the graph goes up, the economy looks great on paper.
And nobody actually feels it.
Exactly. It's the theory that we might be entering this deflationary white-collar recession, completely disguised as an economic boom. We will unpack the mechanics of that later, but I think it perfectly frames everything else we're going to talk about today. It really explains why the stock market can be hitting record highs while regular people just feel stuck.
Okay, so let's start with the entity that is definitely not stuck. The undisputed ruler of the digital world right now, NVIDIA.
The engine room of the AI boom.
Right. And, we knew the numbers would be big. Everyone knows AI is the hot thing right now. But I looked at this Q4 earnings report, and I actually had to stop and count the zeros.
The scale is just staggering. For the fourth quarter, NVIDIA reported revenue of $68.13 billion.
Or $68 billion in 3 months.
Yeah. And just to isolate the part that really matters here, data center sales alone. So the chips that actually run these massive AI models.
Right.
That was $62.3 billion of the total. That is 91% of their entire revenue stream.
Wow.
Basically, they aren't a graphics card company for gamers anymore. They are the core infrastructure of the AI economy.
And they gave guidance that they aren't slowing down either. They're predicting $78 billion for the next quarter.
Correct.
Okay, so here is the part that I just could not wrap my head around. If I'm an investor on Wall Street and I see a company making $68 billion and telling me they're going to make even more next month,
You buy the stock.
I buy the stock. I'm buying champagne. But the stock actually dropped. It fell by like 5% after this news came out. Make that make sense.
It does seem totally backwards. But you have to get inside the head of a Wall Street analyst here. They aren't looking at today's $68 billion. They are looking at 2 years from now, and they are terrified of this concept called CapEx sustainability.
CapEx sustainability. Break that down for us.
CapEx is capital expenditure. It's the physical cash that companies like Microsoft, Google, and Meta are spending to buy these NVIDIA chips to build out their massive data centers.
Okay.
Right now, they're spending tens of billions of dollars every single quarter. It's an unprecedented spending spree. But the fear is, at some point, you finish building the house.
You don't just keep buying bricks forever.
Exactly. Eventually, you have enough data centers. And when Microsoft or Meta finally says, hey, we're good, we don't need any more chips this year, NVIDIA's revenue could just fall off a cliff.
So investors are worried that this is a one-time massive construction boom, not a permanent, reliable revenue stream.
Right. And we are already seeing signs of these tech giants actively trying to break their complete dependence on NVIDIA.
Like what Meta is doing.
Yes, look at Meta. Mark Zuckerberg is still buying millions of NVIDIA GPUs, sure. But this week, reports came out that Meta just signed a huge deal to buy chips from AMD.
Hedging their bets.
Exactly. Up to 6 gigawatts worth of compute power. Plus, they're quietly deploying their own custom-built silicon.
They don't want to be held hostage by one supplier forever. But even beyond the chip competition, there is a much bigger, much more physical constraint hitting these companies. And this is the part of the deep dive that felt a little dystopian to me.
The power grid.
Yes, we are running out of electricity. We aren't just talking about software and code anymore. We are talking about these companies literally sucking the local power grids dry.
We are, and the federal government is acutely aware of it. There was a really fascinating detail in the sources this week about the White House stepping in and extracting a ratepayer protection pledge from these tech giants.
A ratepayer protection pledge, which honestly sounds like something you sign at a sketchy car dealership. What exactly are they pledging?
Well, the administration basically sat down with Amazon, Alphabet, Meta, Microsoft, Oracle, the big players, and said, look, your AI data centers are becoming so incredibly power hungry that you are on track to either crash local grids or severely drive up utility prices for regular families.
Right, because if a massive data center moves into my town and sucks up all the baseline power, my local utility has to go out and buy expensive emergency power on the spot market.
And then your electric bill goes up to cover the cost. Precisely.
Right.
So these companies signed this pledge essentially saying, we will pay for the new power generation ourselves. They are formally promising to either build their own power plants or pay huge premiums to bring new clean energy online, just so everyday consumers aren't footing the bill for AI's energy thirst.
But think about what a massive shift that is. We used to think of a company like Microsoft as just a group of people writing code for Windows or Office.
Now they're basically becoming a utility company.
Yes, they are literally becoming energy infrastructure players just to keep their software running.
It's wild. When you have the GDP of a small country and you are building your own dedicated power grid, you aren't just a tech business anymore. You're operating almost like a sovereign entity.
Which is actually a perfect transition, because while the tech giants are out there building power plants and essentially conquering the world, the old legacy empires, the media companies we all grew up with, are essentially fighting for survival in the mud.
The streaming wars 2.0. Or maybe the final consolidation of the legacy media dinosaurs.
It really feels like that. So let's talk about the total chaos over at Warner Bros. Discovery this week. WBD. Catch us up, because Netflix was sniffing around them, right?
Right. So Netflix had an agreement in principle to acquire WBD. It looked for a minute like a done deal that would just reshape Hollywood. But then, at the absolute 11th hour, Paramount Skydance, let's just call them PSKY, swooped in with an all-cash proposal.
And cash is always king.
Always. And this week, the WBD board officially deemed the Paramount bid superior. That's the specific legal term they used. Paramount is valuing WBD at $31 per share, and critically, they included break fees in the offer.
Meaning if the deal somehow falls apart, Paramount actually has to pay WBD a massive penalty?
Exactly. It shows they are incredibly serious in putting their money where their mouth is. So this officially triggered a 4-business-day window for Netflix to come back and improve their terms if they want to stay in the fight.
The clock is ticking. But here is the absolute plot twist of the week. While all this corporate boardroom poker is happening in Los Angeles, Netflix CEO Ted Sarandos was spotted in Washington, D.C.,
Right.
literally visiting the White House.
The timing is just incredible.
So what is he doing there? Is he asking the administration for permission to make a counteroffer? Or is he asking them to block the Paramount deal?
That is the million-dollar question right now.
Yeah.
You have to remember, this is all happening while the DOJ is actively reviewing broader antitrust issues in the media landscape.
Right, because if Netflix, already the biggest streamer on Earth, by far buys Warner Bros., Discovery, that is a terrifying concentration of power for the industry.
Exactly. So it's highly possible Sarandos was there to take the temperature.
Yeah.
Basically saying, hey, if we bid higher and win this, are you guys going to immediately sue us to block it?
Or conversely, please sue Paramount so we don't have to overpay to win this bidding war.
That is a very cynical but very realistic strategy. But honestly, look at how the stock market reacted. When the news broke that Netflix might actually lose this deal to Paramount, Netflix stock actually rallied.
Wait, investors were happy they lost.
They were relieved. The investors are thinking, thank God we aren't spending billions of dollars on a legacy media company burdened with declining cable channels and old studio baggage.
Right.
It perfectly illustrates where the market sees value right now. They love the clean tech platform of Netflix. They do not want the physical baggage of the old Hollywood system.
And that brings us perfectly to the real baggage part of the economy. We've talked about the digital winners, we've talked about the media dinosaurs. Now we have to look at the pure industrial reality. And looking at the numbers from Stellantis this week, it's just brutal.
It is a total bloodbath. There's really no other word for it.
Stellantis. This is the parent company of Jeep, Ram, Dodge, Chrysler, absolute American legacy icons. And they just posted a net loss of 22.3 billion euros for 2025.
Just to put that number in perspective for you, that is roughly the entire GDP of a country like Iceland. Just gone, vaporized in a single year.
How does a major car company even lose that much money? Did people just completely stop buying Jeeps?
It's a toxic combination of a rocky strategic transition and reality just biting back hard. A massive chunk of that loss, we're talking 25.4 billion euros, was entirely from write-downs.
Write-downs on the EV transition.
Exactly. They basically had to admit to their shareholders that the billions they poured into their aggressive electric vehicle strategy, specifically in their North American operations, just isn't worth what they projected. They overinvested in an EV future that did not arrive anywhere near fast enough.
And this is exactly where that ghost GDP concept we teased earlier really starts to feel tangible. Because while NVIDIA is up in the cloud practically printing money, real physical workers are paying the immediate price for Stellantis' failure.
That is the stark reality. Because of this massive loss, Stellantis officially suspended their 2026 dividend. So shareholders get nothing.
Right.
But far more importantly, the U.S. UAW workers, the men and women actually on the assembly line building these trucks, they usually get a profit-sharing check.
Which is a huge deal for them.
Huge. In a good year. That check can be upwards of $14,000. It's life-changing money. It pays off credit card debt. It funds college. It buys a car.
And this year, because of the 22 billion euro loss?
They get absolutely zero.
Zero. That is just brutal. Imagine counting on that annual bonus, budgeting for it, and then getting nothing because corporate bet too heavily on EVs.
Exactly. And meanwhile, they are reading headlines about NVIDIA employees becoming multimillionaires overnight on their stock options.
Yeah.
The divergence is just staggering. And the thing is, Stellantis knows they messed up. They are frantically pivoting.
Yeah, I saw they're relaunching the Jeep Cherokee.
Right, which historically was one of their absolute best sellers. But they are not launching it as a pure EV.
Whoa, they're retreating.
They're launching it as a traditional hybrid. They're actively walking back the all-electric promise and targeting a 25% retail sales jump in 2026 by just giving consumers what they actually want right now, a vehicle that uses gas and electricity.
But it's not just Stellantis struggling in the physical economy. Ford is having an absolute nightmare of a week, too.
Yeah, Ford is battling their own classic industrial demon quality control. They just had to issue a recall for 4.3 million trucks and SUVs.
4.3 million.
All over a faulty trailer brake module. And on top of that, another 400,000 Explorers were called for steering issues.
Recalling 4 million vehicles is not just a small software patch. That is a massive logistical and financial nightmare.
It costs an absolute fortune to physically fix that many cars. And it just strongly reinforces this broader narrative we're seeing. The physical economy bending metal, tightening bolts, shipping parts is hard, it's low margin, and it is actively struggling.
While the digital economy is seemingly frictionless and infinitely profitable, which brings us, finally, to the absolute core of today's deep dive, this concept of ghost GDP.
Right.
We've been dancing around it all episode, but you pulled this really fascinating note from Citrini Research. Let's really get into it.
I think it's one of the most provocative economic theories to emerge in the last few years.
Okay, lay it out for us. What exactly is the ghost?
So the fundamental premise is this. As AI gets exponentially better, it obviously increases corporate output. It can write code, it can generate massive marketing campaigns, it can analyze complex data, and soon it will autonomously manage entire supply chains.
Right, so the traditional GDP, the total value of all goods and services produced by the country, goes up.
Goes way up. The economy looks fantastic on paper.
The chart goes up and to the right, everyone claps.
Exactly. But here is the catch. Because the AI agents are doing the actual heavy lifting, these corporations don't need to hire more human workers to achieve that growth. In fact, they might start actively shedding jobs.
So you have this deeply weird scenario where national GDP is rising rapidly, but overall human wages and white-collar employment are actually dropping. It's fundamentally deflationary for labor.
Precisely. So the wealth is definitely being created. It exists.
It's just a ghost to the average person.
Yes. It is completely trapped inside corporate balance sheets and the stock market. It does not flow down to the actual worker in the form of a biweekly paycheck. Citrini explicitly calls this a white-collar recession.
Wow.
You know, we are culturally used to blue-collar recessions where the auto factory closes down. This is entirely different. This is a recession where the high-end law firm quietly fires half its junior associates because a custom AI model can review merger contracts faster and better.
Now, obviously not everyone agrees with this totally bleak Terminator-style outlook, right?
Oh, absolutely not. There's fierce debate. Mark Benioff, the CEO of Salesforce, was out making the rounds this week, fighting this exact narrative.
What's his counterargument?
His core argument is augmentation, not replacement. He claims these AI agents will just make existing human workers vastly more productive. And if your workers are 10 times more productive, your company grows faster, and you actually end up hiring more humans to tackle entirely new, higher-level problems.
Right, that's the classic Industrial Revolution defense. The invention of the tractor didn't end farming, it just massively changed what a farmer could do in a day.
Exactly. But the counterargument to that is that cognitive labor might be fundamentally different from physical labor. If an AI can eventually do the deep strategic thinking and execution, what exactly is left for the human to do?
Right.
And because of this underlying anxiety, we are seeing the aggressive financialization of absolutely everything. People are desperately trying to find ways to make money in increasingly weird, abstract places.
Which perfectly brings up that bizarre Mr. Beast story from the research.
Oh, yeah. It fits the ghost economy vibe perfectly.
So for context, Mr. Beast is arguably the biggest YouTuber on the planet. And one of his primary video editors just got caught up in a major insider trading scandal, but not on Wall Street, not trading traditional stocks.
Well, on prediction markets, specifically a platform called Kalshi.
He was literally betting on how well his boss's YouTube videos would perform.
Exactly. Because he was the editor, he had advanced inside knowledge of the video's retention metrics and quality. So he went onto this legal gambling site and placed massive bets on the exact view counts those videos would hit in their first 24 hours.
It is so absurd, but it perfectly shows how hyper-financialized our culture has become. We aren't building physical things anymore. We have people doing insider trading on the performance metrics of digital content. The economy is just becoming one big abstraction layer.
It's pure financialization of attention.
Okay, amidst all this ghost money, AI, betting rings, bleeding car companies, I have to ask, was there any genuinely good news this week for a normal person who just wants to live a normal life?
There actually was one major bright spot, and it affects almost everyone, the housing market.
Finally, I saw the headline, mortgage rates actually dropped.
They did. The 30-year fixed mortgage rate officially fell to 5.98%.
Okay, 5.98. Look, it is definitely not the magical 3% we all had back in 2021, but it starts with a 5. Why is breaking that specific number so important to the market?
It is entirely psychological. For the last 2 to 3 years, the entire housing market has been stuck in a deep freeze because of the lock-in effect.
Right.
Nobody wanted to sell their current house because they were locked in to a super low pandemic-era rate. Who in their right mind trades a 3% mortgage for an 8% mortgage? You just don't move.
You stay put.
Yeah.
So there was absolutely no inventory for new buyers.
Zero inventory. But historically and psychologically, breaking back below 6% is widely seen as the magic threshold. It's a point where the financial pain finally becomes manageable.
Right.
A family might look at the math and say, okay, I really hate giving up my 3%, but 5.9 isn't completely catastrophic. We can finally move for that new job, or we can afford to upgrade for that second kid.
So we might actually start seeing for sale signs popping up in neighborhoods again.
Exactly. It's the first real sign of a thaw. And for the real physical economy, construction workers, furniture sales, moving companies, local hardware stores, that is incredibly good news.
Okay, I will absolutely take a little ray of sunshine. Now, to wrap things up, let's keep the energy high. We have a few quick hits from the week to run through because the future is getting weird in some very specific, granular ways.
Let's run through them.
First up, flying taxis. I feel like I have been promised a flying car since I was 5 years old watching cartoons. Is this actually finally happening?
It is actually happening right now in Dubai. Uber Air is officially launching a massive partnership with Joby Aviation.
Okay, but is this just an expensive helicopter ride for billionaires?
Sort of, but the underlying tech is fundamentally different. These are electric vertical takeoff and landing vehicles.
Yeah.
eVTOLs. They are significantly quieter and supposedly much cheaper to operate and maintain than traditional helicopters.
Okay.
And the software integration is the really cool part. You literally just book it on your standard Uber app. You take an Uber Black car to the local vertiport, it flies straight over all the highway traffic, and another car picks you up on the other side.
I am guessing that little commute is not going to cost the same as an UberX.
Oh, definitely not. But it is a real functioning start to a new industry.
All right, pivoting from high-end aerospace to fast food, Burger King is apparently revamping the Whopper.
This is critical breaking news.
It is. No, seriously, they are fundamentally changing the bun and the mayo. Creamier mayo is literally the corporate headline here.
It sounds completely silly after talking about AI and power grids, but it's actually about industrial consistency. Burger King realized their franchise quality control was all over the place.
Right.
In the physical economy, making the exact same burger a million times a day across the globe is actually incredibly difficult. So they are re-engineering the ingredients to standardize the physical output.
I completely respect the quest for a more consistent bun. Okay, next up, quantum computing. This is usually the stuff of pure science fiction, but someone is actually turning a profit.
Yes, a company called IonQ. They just beat their 2025 revenue targets, hitting $130 million in actual revenue.
Real money.
Real money. And they are using it to acquire a major manufacturing company called Skywater Technology to build their specialized chips.
So quantum is officially moving out of the university science lab and into an actual viable business model.
Slowly but surely. I mean, 130 million is obviously a rounding error for a giant like NVIDIA, but it definitively proves that enterprise customers are now willing to pay real money for quantum processing power. It's getting real.
And finally, the absolute weirdest, most unsettling story of the week, a stowaway.
This is a total security nightmare. A passenger literally flew on a United Airlines flight from Newark to Milan.
That is an 8-hour international flight.
Without a ticket.
How? We live in a total surveillance state. I have to scan my face just to unlock my phone. I have to scan my boarding pass 3 times, take off my shoes, go through a millimeter wave scanner. How does a human being just walk onto a transatlantic flight?
That is exactly what the Department of Homeland Security is aggressively trying to figure out right now. The person was eventually caught when they landed in Milan, but the sheer fact that they made it through all those layers onto the plane and just sat there for 8 hours.
It's wild.
It really just shows that for all our advanced AI and facial recognition technology, basic physical security in the real world is still incredibly full of holes.
Unbelievable. Okay, let's take a step back and look at the whole picture today.
Right.
We have covered a massive amount of ground.
We really have.
We have NVIDIA making so much money they practically don't know what to do with it, while Stellantis is bleeding billions of euros on assembly lines. We have Microsoft building literal power plants.
Yeah.
And we have the looming threat of ghost GDP hanging over the labor market.
It all circles back to that fundamental divergence we started with. If you are listening to this and just trying to make sense of where the world is heading, you have to closely watch where the capital is flowing. Right now, capital is flowing aggressively into digital intelligence and energy infrastructure, and it is actively fleeing from traditional physical manufacturing and human labor.
That really is the scary part. The money is literally running away from the people.
And I think that leads us directly to the really big question we need to be asking ourselves moving forward.
Let's hear it.
If this ghost GDP theory is actually right, if AI can generate massive, unprecedented corporate wealth without actually needing a large human workforce,
Yeah.
and if these massive tech giants are simultaneously building out their own private infrastructure, their own sovereign power grids, their own custom silicon, their own closed ecosystems.
Are they basically building an entirely new economy that simply doesn't need us anymore?
Exactly. Are we rapidly moving toward a world where the 5 biggest companies operate in a completely closed loop, generating infinite value for themselves while the rest of society is just left watching from the outside?
Well, on that wonderfully terrifying note, that is certainly something for you to think about tonight while you're browsing Zillow for those new sub-6% houses.
Indeed.
Thanks for joining us for this deep dive. We will be back right here next week, assuming the AI hasn't completely replaced us by then.
Fingers crossed it hasn't.
It's a